London School of Economics, October 1994, Thursday afternoon. George Soros stands at the front of a lecture hall holding 400 students, economics majors, graduate students, a few professors in the back rows. The room smells like old books and nervous ambition. Wood paneling on the walls, high ceilings, the kind of space built for serious thinking. Soros is 64, grey hair, dark suit, no notes. He never uses notes. He's been invited to give the annual Lionel Robbins Memorial Lecture, an honor. Previous speakers include Friedrich Hayek, Milton Friedman, Paul Samuelson, giants of economic thought. The topic: the theory of reflexivity and market behavior. Most students came expecting traditional economic theory, supply curves, demand curves, efficient market hypothesis, the comfortable mathematics that makes economics feel like physics, predictable, rational, safe. But Soros isn't here to comfort them. He's been speaking for 40 minutes, explaining his theory of reflexivity, how markets don't just reflect reality, they shape it, how participant bias becomes market bias, becomes fundamental bias, how boom-bust cycles aren't random but follow predictable patterns of feedback loops, how believing markets are rational makes you blind to how markets actually work. The students are confused. This contradicts everything they've learned. Their textbooks say markets are efficient information processors. Their professors teach that prices reflect all available information. Their models assume rational actors making optimal decisions. Soros is saying it's all wrong. A hand goes up. Row 7. A student stands, male, early 20s, confident posture, the kind of student who speaks first in every class, who has opinions ready before questions finish. Mr. Soros, he says. His accent is American, probably Ivy League, probably never wrong on an exam. I have to respectfully challenge your premise. The room goes quiet. You don't challenge George Soros. Not publicly. Not when he's made billions proving his theories work. But this student doesn't know that yet. Or doesn't care. Markets are rational, the student continues. The efficient market hypothesis has been proven mathematically. Prices reflect all available information. Short-term fluctuations might appear irrational, but over time, markets converge to fundamental value. What you're describing sounds like cherry-picking examples that fit your narrative, while ignoring the broader evidence of market efficiency. Silence. The room holds its breath. Professors in the back exchange glances. This is going to be interesting. Soros doesn't react. Doesn't look angry or defensive. Just looks at the student with something between curiosity and pity. Like a chess master watching a beginner make an obvious mistake. What's your name? Soros asks. Marcus. Marcus Richardson. Where are you from? Marcus? Massachusetts. I did my undergraduate at Harvard. I'm here for graduate studies in economics. Good school, Soros says. They taught you the efficient market hypothesis? Yes, sir. It's fundamental to modern finance theory. Did they also teach you that theories should match reality? Marcus hesitates. Yes, of course. Then let me show you why everything you learned is wrong. The room leans in. This is why they came. Not for lectures. For moments like this. Soros walks to the blackboard, picks up chalk, starts writing. The efficient market hypothesis makes 3 assumptions. First, all market participants have access to the same information. Second, all participants process that information rationally. Third, prices adjust instantly to new information, reflecting fundamental value. He turns to Marcus. Do you agree those are the core assumptions? Yes. That's the standard formulation. Good. Now watch me dismantle each one. Soros writes a date, the 19th of October 1987, Black Monday. The stock market crashed 23% in one day, the largest single-day percentage decline in history. Tell me, Marcus, what new information arrived on October 19th that justified a 23% reduction in the fundamental value of American companies? Marcus thinks. Portfolio insurance algorithms triggered automated selling. That created downward pressure. Did the algorithms have new information about corporate earnings? About economic growth? About anything fundamental? No, but... So prices moved 23% without new information. which violates your first assumption. Prices don't reflect information. They reflect behavior. Specifically, they reflect the behavior of market participants responding to other market participants' behavior. That's a feedback loop. That's reflexivity. Soros writes another date, the 16th of September, 1992. Black Wednesday. I bet $10 billion that Britain would devalue the pound. The pound was overvalued. The peg was unsustainable. Anyone with access to the same information I had could see it. But most market participants didn't act on it. Why? Because they assumed the Bank of England would defend the peg. They processed the information through the lens of their expectations, not rationally, behaviorally. He circles the date. When I took the position, I wasn't reacting to information, I was creating information. My bet increased selling pressure. Other traders saw the pressure and piled in. The feedback loop accelerated until Britain capitulated. I didn't predict an exogenous event. I participated in creating the event. The market didn't reflect reality. The market changed reality. Marcus raises his hand again. But that's an exceptional case. George Soros moving markets. Most participants can't do that. You're missing the point, Soros says. It's not about size. It's about the mechanism. Every trade affects price. Every price affects perception. Every perception affects the next trade. Markets are reflexive systems where cause and effect are circular, not rational systems where information translates directly into price. He writes a third date, 1999 to 2000. The dot-com bubble. Internet stocks trading at valuations disconnected from any reasonable projection of future earnings. Rational? No. But sustainable for years because the price appreciation itself became the justification for buying. Investors didn't analyze business models. They bought because prices were rising. Prices rose because investors were buying. Classic reflexive boom. It ended when reality finally overwhelmed perception. But the bubble lasted years. If markets were efficient, it would have lasted days. Soros sets down the chalk, walks closer to Marcus. Let me tell you what your professors didn't teach you. They didn't teach you that humans are not rational actors. They're pattern-seeking animals operating under uncertainty with incomplete information and emotional biases. They didn't teach you that markets are composed of these humans, which means markets inherit their irrationality. They didn't teach you that mathematical elegance doesn't equal descriptive accuracy. He points at the equations on the blackboard behind him. Economics formulas, supply and demand curves, perfect mathematical beauty. Those equations are beautiful, symmetric, elegant, but they describe a world that doesn't exist. A world where participants have perfect information, unlimited processing capability, no emotional biases, and instant execution. That world exists in your textbooks, not in reality. Marcus tries again. But over long time horizons, markets do converge to fundamental value. Short-term irrationality gets arbitraged away. By whom? Soros interrupts. By rational arbitrageurs? Let me tell you what happens to rational arbitrageurs. They identify mispricings. They take positions. Then the mispricings get worse before they correct. The arbitrageurs run out of capital. They get margin calls. They liquidate at losses. Then, after they're forced out, the mispricing corrects. Ask long-term capital management how rational arbitrage works. He walks back to the board, draws a circle with arrows pointing in both directions. This is a reflexive system. Prices affect fundamentals. Fundamentals affect prices. Each change reinforces the next. Booms become bubbles because rising prices attract capital, which pushes prices higher, which attracts more capital. Busts become crashes because falling prices trigger selling, which pushes prices lower, which triggers more selling. The cycle continues until something external breaks it. A professor in the back raises his hand. Mr. Soros, if markets are as irrational as you claim, how do you explain the success of index investing? The fact that most active managers underperform passive strategies suggests markets are efficient enough that beating them is nearly impossible. Good question, Soros says, but you're confusing two different things. Markets being hard to beat doesn't mean markets are efficient. It means most investors are equally irrational. They chase trends. They panic during crashes. They buy high and sell low. The average active manager underperforms because they're part of the herd, not because markets are efficient. He points at himself. I beat markets consistently because I understand they're inefficient. I look for moments of extreme reflexivity, unsustainable trends, feedback loops approaching breaking points. I bet against herd behavior when it reaches extremes. That's not luck, that's understanding the mechanism. Marcus won't let it go. But your success could be statistical noise, survivorship bias. For every George Soros, there are thousands of traders who lost everything betting against markets. Now Soros smiles. Not friendly, the smile of someone about to teach a painful lesson. You think I'm a statistical anomaly? I'm saying it's possible. One person getting rich doesn't invalidate a theoretical framework supported by decades of academic research. Soros walks closer, stops 3 feet from Marcus. The room is dead silent. Let me tell you something about academic research. It's backward-looking. It analyzes what happened. It creates theories to explain historical data, then it assumes those theories predict the future. But markets don't follow theories. Markets follow human behavior. And human behavior under uncertainty is not rational. He gestures at the students. Everyone in this room believes they're rational, believes they make decisions based on logical analysis of available information. But you don't. You make decisions based on incomplete information filtered through cognitive biases you're not aware of. Then you rationalize those decisions afterward. That's how humans work. That's how markets work. Marcus crosses his arms. Defensive posture. So your theory is that markets are just random? That there's no pattern? No predictability? No, Soros says. My theory is that markets follow patterns of boom and bust driven by reflexive feedback loops between prices and fundamentals. Those patterns are predictable if you understand the mechanism. But you can't predict them using equilibrium models that assume rationality. You need to understand behavioral dynamics, feedback effects, tipping points. He walks to the window, looks out at London, grey sky, rain starting to fall. I made $1 billion in 48 hours shorting the pound. Not because I had information others didn't have, because I understood that Britain's position was unsustainable, and that when unsustainable situations persist, they eventually collapse. That's not rational market efficiency. That's understanding reflexive dynamics. He turns back to the room. Here's what efficient market theory can't explain. Why do booms overshoot fair value? Why do crashes undershoot? Why do asset prices swing wildly while underlying fundamentals change gradually? Why do bubbles persist for years? Why do informed investors consistently lose money? Because markets are not efficient information processors. They're reflexive systems where perception and reality interact in feedback loops. A student near the front raises her hand. Mr. Soros, if everything you're saying is true, why do universities still teach efficient market theory? Because it's mathematically elegant. Because it allows researchers to publish papers using sophisticated quantitative techniques. Because accepting that markets are reflexive and fundamentally unpredictable is uncomfortable. Much easier to assume rationality and build models that appear precise but describe nothing real. Marcus tries one more time. But without a rational framework, how do you make decisions? How do you know when to buy or sell? You're just replacing one theory with chaos. And this is where Soros says, the thing that will stay with Marcus for the rest of his life. I don't need a theory that's always right. I need a theory that's useful. Efficient market theory is elegant but useless. It tells you markets are rational and you can't beat them. Fine, that's an excuse to buy index funds and go home. Reflexivity theory tells you markets are irrational feedback systems prone to booms and busts. That's useful. That gives you something to act on. He walks back to the blackboard, writes one sentence in large letters. The goal isn't to be right. The goal is to make money. Your professors taught you that good theory equals accurate description of reality. That's wrong. Good theory equals useful framework for making decisions under uncertainty. Reflexivity is useful because it helps me identify opportunities that rational market theory says don't exist. He caps the chalk. When everyone believes markets are efficient, they stop looking for inefficiencies. That creates inefficiencies. When everyone believes prices reflect fundamentals, they stop questioning whether prices have divorced from fundamentals. That creates bubbles. When everyone acts on the same rational model, they create irrational herd behavior. That's the paradox your professors won't teach you. The room is quiet. Not challenging quiet, thinking quiet. Marcus sits down. His face has changed. Not convinced yet, but doubting. The certainty he walked in with has cracks. A student in the back asks, "How do we learn to see these reflexive patterns? How do we know when a boom becomes a bubble? When does a correction become a crash?" Experience, Soros says. You live through cycles, you watch bubbles inflate, you feel the euphoria. You recognize when fundamentals no longer justify prices but prices keep rising anyway. You develop intuition for when feedback loops approach tipping points. You can't learn it from textbooks. You learn it by participating, by being wrong, by losing money, by surviving long enough to recognize patterns. Another student, "But that sounds like alchemy, not science. How is that better than efficient market theory?" Because it works, Soros says simply. I don't care if it's elegant. I don't care if it publishes well. I care if it helps me understand market dynamics and make profitable decisions. And it does. Consistently. For 30 years. He picks up his papers. The lecture time is ending. Let me leave you with this. You came here believing markets are rational, believing prices reflect information, believing your job as investors is to analyze fundamentals and let the market do the rest. That's comfortable. That's safe. That's what your professors taught you. He pauses. But that's not how fortunes are made. Fortunes are made by understanding that markets are irrational, by recognizing when prices have divorced from fundamentals, by betting against consensus when consensus is wrong, by having conviction when everyone else doubts. He looks directly at Marcus. You asked if my success is statistical noise. Here's my answer. I don't believe in markets being efficient. I believe in them being predictably irrational. That belief has made me billions. Your belief that markets are efficient will make you average returns at best. Choose which belief serves you better. Marcus sits frozen, processing, fighting the cognitive dissonance between 4 years of education and 40 minutes of reality. The lecture ends. Students file out. Some approach Soros with questions. Others leave quietly, reconsidering everything they thought they knew. Marcus doesn't leave, sits in his seat, staring at the blackboard, at the equations, at the sentence Soros wrote. The goal isn't to be right, the goal is to make money. 3 years later, Marcus graduates, takes a job at a hedge fund, tries applying efficient market theory, gets crushed during the Asian financial crisis, loses 40% of his portfolio betting that currencies would return to rational levels. They don't. The crisis deepens. Feedback loops accelerate. He remembers the lecture, remembers Soros explaining reflexive booms and busts, remembers the lesson he didn't want to learn. Markets aren't rational, they're human. Marcus changes his approach, stops looking for fair value, starts looking for unsustainable trends, for feedback loops approaching tipping points, for moments when consensus is extremely confident and extremely wrong. 10 years later, he runs his own fund, applies reflexivity theory, makes money during the 2008 financial crisis betting against mortgage securities everyone else thought were safe. Not because he predicted the housing market would collapse, because he recognized an unsustainable boom driven by reflexive feedback between prices, lending standards, and investor appetite. Someone asks him where he learned to see bubbles before they burst. Marcus tells them about a lecture in 1994, about a student who challenged George Soros, about learning that being right about theory doesn't matter if the theory doesn't help you make money. The story spreads, not widely, but among traders who understand, who've lived through enough cycles to recognize that markets aren't rational machines processing information. They're human systems processing fear and greed, and hope and panic. George Soros changed how Wall Street thinks, not by writing academic papers, not by teaching courses, but by proving, over and over, that understanding human behavior beats understanding mathematical models. That success in markets comes from recognizing irrationality, not denying it, that the goal isn't to be right about theory, the goal is to make money in reality, and reality is reflexive, messy, human, profitable for those who see it clearly. 40 minutes in a lecture hall, One student defending efficient markets. One investor who made billions betting against them. The lesson wasn't about who won the argument. The lesson was about which belief produces results. Marcus learned that lesson. Eventually, after losing money, after fighting reality, after finally accepting that markets don't care about theoretical elegance, they care about human behavior. And human behavior under uncertainty isn't rational, it's reflexive. Understanding that difference is worth billions.